Welcome back for another episode. In this week's episode of the Retire While You Work podcast, I'm Miles Zuger, a wealth advisor here at Adams Wealth Partners, joined by Carson Odom, another wealth advisor here at Adams Wealth Partners. Today's topic is charitable giving or financial planning involving giving to charities. And we want to provide a few ideas on how we can think it can be done most effectively. With the biggest goal being to help and benefit those charities, but also, if you give to charity at times, there can be a nice tax deduction for doing it as well. So that is part of it. We want to touch on that. And there's a ton of ways to give, whether that's with time, financially, whatever other resources, those charities or foundations may need. And so it doesn't always have to be money. I think we'll probably focus on that in terms of today, just from the financial planning aspect. But, there's a ton of ways you can get out there and help local charities. And a lot of it can be done just with time. I know this past weekend, our team participated in the Extra Mile, which is the Down syndrome walk here in Middle Tennessee. This coming weekend, we're going to be doing the Alzheimer's walk here in town. So it's something that's important to all of us here on the team, giving back and helping out. And so those are just a couple of the local ones that we've been doing and wanted to highlight. But Carson, any thoughts on charitable giving and how people can get started, maybe what the easiest way for somebody to get started if they're maybe not doing it and looking to get active with it?
I think, being charitable is a great way just to adjust your heart, adjust your mind, just around your finances. I think as a whole, regardless of how you were raised, what you believe in, so on and so forth, I think it's a great attitude to be charitable with the assets that you have or the income that you have. And I think a lot of people think initially about you either serve with your time, give your time, or just write a check, give online to donations or to charities, make donations to charities. And it's very simple. That's probably the large majority of ways to donate, but it can get complex to a point where it can really impact your financial plan depending on how you give and what methods you give. I think we all know that if you give, everybody hears it's a tax write-off. So how that works as a whole is there's something called itemized deductions. I don't want to get too far into the weeds, but the government says for a married couple, you get a standard deduction and it's worth for 2024, $29,200. So if a few things don't add up to be more than $29,200 for 2024, it doesn't technically help you from a tax perspective. If you give $1,000 to a charity and you take the standard deduction, it doesn't help you from a tax perspective. Now, that shouldn't be what's driving your intent to be charitable. Just because you get a tax deduction, it's nice. Now, on the other side of that, if you do give a lot and it itemizes out to be more than the standard deduction, that's where every dollar that you give helps you because it increases your itemized deductions. And that's the simplest form, is just writing a check or donating online, putting on your credit card, so on and so forth. It can broadly help you on your taxes, depending on your tax situation. Everybody's tax situation is different. Now, beyond that, there are some really specific ways to get creative with how you donate, especially you can be creative with cash. You can also be creative with property or investments that you have. You want to kind of touch on the appreciated investments?
Yeah. I would just kind of wrap that up by saying too, I think where we've seen clients have maybe the most, I guess I'll use the word success when giving to charity or foundations, is something that they're passionate about. It's a cause that maybe they've been affected by or their family has been affected by, that they can really get behind and want to support. And I know that's how we're very involved with the Down syndrome walk here and the Alzheimer's walk and the hard of hearing for myself that I'm involved in. And so we've all kind of found something that we're passionate about. And it makes it a lot easier to want to give time, want to give money to those types of causes. When you're, to Carson's point, they're kind of transitioning now to how to give or where to give. When you're looking at giving, the easiest way is obviously just to give cash. You give a small amount, a big amount, whatever it might be. That's kind of just the cleanest cut way to do it. And it immediately can benefit the charity or foundation, et cetera. I think everybody's probably given to something at some point in time. The next way is, maybe you're somebody who bought a stock for not a lot of money and you saw that stock price over the last however many years appreciate rapidly. And let's just say, use numbers here. You put $100,000 into it, and you were fortunate enough to see that grow to $1 million. And obviously, if you were to sell that, there's a pretty large capital gain that you'd have to realize, pay taxes on, and then you'd be able to donate that money to charity. But what we see people do a lot of times with highly appreciated stock is they will actually just donate that stock to the foundation or charity if they're able to accept it. And that does a couple things for the donor. It allows you to not have to realize that capital gain. And rather than, selling that stock, and let's just say you have a 20% capital gain. So after taxes, it's, $700,000 or $800,000 that you're able to give. You're now able to give $1 million and you didn't have to pay any taxes. So it's just a very efficient way to do that. And then depending on income, is dependent about how much you can deduct of that in any year. But if you, for whatever reason, based on your adjusted gross income, can't deduct all of that in one year, you then get to carry that over to the next. So it's not like it just goes to waste because of the amount that you gave.
It's a great way, donating a highly appreciated stock, to think about it, especially if you were planning on donating via cash, because what you can do is, yes, you can write a check, but it can help your financial situation, because if you donate the highly appreciated stock, in Miles' scenario, cost base is 100, worth $1 million. You could even use this with small numbers. You bought it for 1,000, worth 10 grand. On that scenario, you donate the stock with 10 grand. Instead of writing a check for 10 grand, now turn around, rebuy the stock you just donated that's worth $10,000. And all of a sudden, you have made your charitable contribution. You still own the stock, but now your cost basis is no longer 1,000, because that lot has been donated to the charity. You rebuy at the $10,000, and now you have zero unrealized gain loss in this scenario, because you have essentially passed the unrealized gain in that stock to the charity. And now you have repurchased the stock and raised your cost basis. It's as if you wrote a check and had your cost basis raised by doing it this way. This doesn't have to be done with a stock investment. This can be done with a real estate, for example. Now, you're not going to go out and rebuy the same property, but you can donate vehicles, you can donate collectibles, you can donate very different things. It's not just with stock. It's very easy to explain whenever it comes to stock and investments like that. But it's a great way to maximize your personal investment situation. It can be just random parts of your portfolio that have appreciated. Why not? Even if it's not a huge gain, why not raise your cost basis if you're going to be donating this cash anyway?
Yeah. And I think it's important to note that if you're donating stock, it really only makes sense to do it if it is highly appreciated, because if you have a loss in that stock, you're much better off to sell the stock, realize the loss, which is a capital loss to you, which you can write off against other capital gains down the road, or maybe in that same year, and then give that cash in that scenario, because it's kind of a double benefit to you there, in that you build up a capital loss to be able to use, and you also gave cash to that charity. So it's kind of a double benefit when doing that. So when gifting stock, the big thing to know is you really only want to do it with stock that is highly appreciated or appreciated in some way. The other part is maybe you're somebody who's charitably inclined, but you just don't know where you want to give to yet. And it can be expensive to start up some sort of family foundation and the carrying cost of that, and you have to give so much of it each year. So the alternative there is we have them at Raymond James. They're available other places, but they're called donor advised funds. And what this is think of it like a family foundation, but it's just a very low cost way to do it, to where it's held at Raymond James. You're able to gift cash or assets, appreciated assets, stocks, mutual funds, ETFs, into this donor advised fund. You immediately in that tax year are able to recognize that tax loss. And then as you're wanting to or able to, you can then in the current year, 1, 2, 3, 5, 10 years down the road, give cash or assets from that donor advised fund to select charity of your choice. You don't get a second write-off at that point, but the benefit is you realized it immediately and didn't necessarily have to give that money today, essentially.
Yep. The big benefit there is timing. That's the big benefit of a DAF, donor advised fund, is timing. It's all generating the charitable deduction the year in which you make the gift, even though you might not distribute the funds out of that DAF to the charity for a decade to come. And in the meantime, while it's sitting inside of the donor advised fund, you can invest it. You could keep it in a money market. You can invest it in the stock market, invest it in bonds, and it can go up and down with the stock market to have the potential to grow, which would then allow for more money that can be given to the charity. But the big thing, like you said, Miles, is you realize the charitable deduction in the year in which you give it to the donor advised fund, not in the year in which it's distributed to the charity. So if you have a huge income year and you want to be charitable with some amount of money, it's a great way to park it into a donor advised fund. Know that, okay, I had a huge income year. I realized that deduction in this year that I had the big income that's going to be reported. Now I can let time sit. I can think about, okay, how do I want to use these funds and donate? You can take as much time as you need. The only really kind of rule is once money goes in there, it can't come back out, and it has to go to a 501c3 charity. You can't donate to a donor advised fund and then decide to gift something to your buddy or a family member who needs help. Has to go to a 501c3 organization. You can't have any sort of personal benefit or anything like that. Other than that, there's some other rules and regulations around donor advised funds, but that's pretty much it for the most part.
Yeah, that's good. A couple notes there.
Yep. I think one of the last things that we wanted to hit on were QCDs. Is that it? I think that's the last thing we wanted to hit
That's
on.
another one. Yep, definitely a good one.
QCDs stands for qualified charitable distributions. So we got DAFs, DAFs, donor advised funds. We've got another acronym, QCDs, qualified charitable distributions. So this is for people who have money inside of an IRA. So this is a traditional IRA. And one of the rules is you have to be at least 70 and a half. Now, what you can do with a qualified charitable distribution is up to $100,000 per year, you can donate to a charity directly from your IRA. And we can handle these for clients that have accounts here at Raymond James, but we can essentially have money sent directly from an IRA to the charity. Now, let's think about how this is beneficial. As I mentioned earlier with your tax return, if you have 100 grand of income and you've got that 29,000 standard deduction, if you pull money out of your IRA to give to the charity, you pay taxes on that IRA distribution, but you may not get any additional tax benefit because your standard deduction is so high and you don't give enough to charity to realize that. By doing a QCD, qualified charitable distribution, you do not pay taxes on that IRA distribution because it is going straight to the charity. So now you get the benefit of not even reporting the income in the first place. So that is in essence why QCDs can be so beneficial. Even if you're in RMD status and you have to start pulling money out of your IRA and you're 73 or older right now, if you give any amount to charity and you pull out your RMD, why not take $100, $200, whatever the amount is, and do a QCD just to lower your taxable gross income?
Yeah. And I think, most people in retirement probably, I think it's safe to say, have a lower tax bracket than they were in their working years, but it's a good way to save. And for somebody who's maybe in a higher tax bracket and just doesn't need, I see two scenarios. Somebody's in a higher tax bracket, still doesn't need that income. It's a great way to give to charity because it's just less taxable income being piled onto you. Likewise, for somebody who is charitably inclined and maybe in call it a medium tax bracket somewhere, and they have been giving out of cash and now they're about to start RMDs or at 70 and a half are still able to do this. I guess that's important to note because it was something I learned this year too. Yes, the RMD age is up to 73, but this QCD rule is still at 70 and a half. This is as of November of 2024. So this QCD rule is still in place for those at 70 and a half. But it's a way for those to give out of an IRA, and then maybe they have another account that they're pulling income from, and it allows them just to stay in a little bit lower tax bracket. So you can be very, really whatever tax bracket you're in, you can be very strategic on where if you're pulling most of your income from investments to live on in retirement. You can be very strategic on exactly what you're doing just to help maximize things and really just keep efficiency and tax breaks going for you where you can.
Yeah, that's right. I think the highlight is you can keep it simple and just donate cash to a charity. just to kind of summarize what we talked about. If you have some highly appreciated investments, especially stock market related ETFs, mutual funds, and you're going to donate to charity, you can use those to kind of pass off the unrealized gain. You can use a DAF, a donor advised fund, if you have a big income year and you want to get the tax deduction, but you don't want to donate to the charity yet. And then lastly, there's QCDs, qualified charitable distributions, which if you're over 70 and a half, you give to charity, you pull money out of your IRA. You might as well use a QCD to lower your gross income that you're taxed on. So that's it in a nutshell.
Yeah. And I think what's cool about all three of these strategies is I know we were sitting with the client yesterday talking through some of these. And I think what's cool about them is I think a lot of people, especially when you're talking about larger sums of money, maybe that they want to leave to charity or some organization when they pass away. A lot of people think, well, I'll give that when I pass away. But then when you talk through these strategies and talk about the tax benefits and, giving appreciated stock and donor advised funds and things like that, it actually allows people to give to these types of organizations and charities while they're still living and actually see that organization reap the benefits of their gifts and put them to use so that they can see how they're used and participate in that a little bit more versus not being able to give until they pass away and not being able to see how the organization used the funds for the betterment. Yeah. So I think it's a cool way to not only get a tax benefit out of it, which is a good thing, but it also allows you to see how your gifts can benefit those organizations, and you can be around to see and take advantage of that.
Yeah, I like that. That's good. So, at the end of the day, I think we encourage everybody to be charitable, at least to some degree, with assets and money. I think it's a great mindset to have. But of course, if there's any, there are strategies that get more complex than this. And if you feel like that's you, or if you have questions about donor advised funds or QCDs or anything like that, we're here to help. Feel free to give me or Miles an email. Happy to help out with that.
Yeah. This is really just the tip of the iceberg. So we can always continue to talk through, but thanks for joining us here again today. And we'll see you guys next week.
See you next time.
Any opinions are those of myself and not necessarily those of Raymond James. Expressions of opinion are as of this date and are subject to change without notice. The information contained in these podcasts do not purport to be a complete description of the securities market or developments referred to in this material. The information has been obtained from sources considered to be reliable, but we do not guarantee that the foregoing material is accurate or complete. Every investor's situation is unique, and you should consider your investment goals, risk tolerance, and time horizon before making any investment. Prior to making an investment decision, please consult with your financial advisor about your individual situation. Any hypothetical examples are for illustration purposes only. Actual investor results will vary. Raymond James does not provide legal or tax services. Please discuss these matters with the appropriate professional.